Imagine you wake up to the news that the stock market is in free fall, the numbers are dropping fast, your investments are losing value, and the economy seems to be unraveling. You think, what happened? In many cases, the answer lies in decisions made by the Federal Reserve. The Fed, with its power to control the flow of money, is one of the most influential institutions in the world. Their decisions, especially the ones regarding interest rates, have the potential to move markets in ways that can cause massive financial instability. Today, we're going to break down how the Federal Reserve's next move could trigger a market crash and what we should all be watching out for. By the end of this video, you'll have a clearer understanding of why the Fed is so powerful and why its actions could send shockwaves through the economy. Stay tuned. 10. The Federal Reserve. Who are they and what do they do? Before we dive deep into how the Fed can crash the market, let's take a step back and make sure we're all on the same page about what the Fed is and how it operates. The Federal Reserve, also known simply as the Fed, is the central bank of the United States. It was established in 1913 with the aim of providing the country with a safer, more flexible, and more stable monetary and financial system. In essence, the Fed is the institution responsible for overseeing and controlling the nation's money supply and regulating the banking system. The main tools the Fed uses are setting interest rates, controlling inflation, and managing the economy's money supply. But perhaps the most impactful tool it has is its control over interest rates. When the Fed changes its target interest rate, it can set off a chain reaction that affects the entire economy and sometimes the global financial markets. So now that we know what the Fed is, let's explore how their next decision could send the markets into a tailspin. The power of interest rates. The most significant tool the Fed uses to influence the economy is its control over interest rates. The Fed's decision to raise or lower interest rates has far-reaching effects on both consumers and businesses. Higher interest rates make borrowing money more expensive, while lower interest rates make borrowing cheaper. Here's where it gets interesting. When the Fed raises interest rates, it affects everything from credit card payments to mortgage rates to corporate loans. And when borrowing becomes more expensive, people and businesses tend to spend less. This can slow down the economy as both consumer spending and business investment decline. However, the big problem comes when the Fed raises interest rates too quickly or too much. If borrowing costs become prohibitively high, it could lead to a contraction in the economy. And when the economy contracts, the stock market tends to follow. This sudden pullback in market activity could easily trigger a market crash. 8. The risk of over-tightening. Let's say the Fed is concerned about inflation. In an attempt to cool down the economy and bring prices under control, the Fed could start raising interest rates aggressively. This is called tightening, and it's meant to slow down inflation by making borrowing more expensive. However, if the Fed tightens too much, too quickly, it could risk going too far. Over-tightening could choke off economic growth entirely, leading to a recession. When businesses slow down, jobs are lost, and consumer spending drops. A domino effect starts, and this is when you'll see a sell-off in the stock market. If investors start to panic, the market could crash. 7. The impact of inflation on the Fed's actions. Inflation is one of the main reasons the Fed might raise interest rates. When prices for everyday goods like groceries and gas rise too quickly, it can create a serious problem for consumers. The Fed aims to keep inflation in check because high inflation erodes purchasing power and can make life difficult for everyone. However, when inflation is high, the Fed might raise interest rates to slow down the economy. While this might seem like a necessary move, it can also have unintended consequences. If inflation is driven by supply-side factors, like oil shortages or supply chain disruptions, raising interest rates might not solve the problem. It could, however, still cause a sharp drop in demand, triggering an economic slowdown, and with it, a market crash. 6. The Fed's impact on consumer confidence. Consumer confidence is a key factor that drives the economy. When people feel confident about their financial future, they are more likely to spend money, invest, and make big purchases like homes and cars. On the other hand, when people start to feel uncertain about their economic prospects, they tend to pull back on spending. The Fed's actions play a huge role in shaping consumer confidence. When the Fed raises interest rates or signals that they might do so, It can send a signal to consumers that the economy may be slowing down. If consumers feel uncertain about their financial situation, they may stop spending as much. This drop in demand can hurt businesses, which then reduces profits and causes stock prices to fall. If the drop in confidence is widespread, it could trigger a market-wide crash. 5. The global impact of the Fed's decisions. The United States economy is the largest in the world, and its financial markets have a global influence. When the Fed makes a decision that shakes the U.S. economy, the ripple effects are often felt worldwide. A change in U.S. interest rates, for example, can lead to changes in currency exchange rates, which can affect international trade and investment flows. For example, when the Fed raises interest rates, the U.S. dollar tends to strengthen. A stronger dollar can make U.S. exports more expensive for foreign buyers, which could hurt U.S. companies that rely on international sales. At the same time, global investors may shift their investments out of emerging markets and back into U.S. assets, causing volatility in those markets. This global instability could contribute to a broader market crash. The stock market and interest rates, a delicate balance. The stock market is particularly sensitive to changes in interest rates. When interest rates rise, the cost of borrowing increases for companies, which can hurt their profitability. As a result, stock prices may fall. On the other hand, lower interest rates make borrowing cheaper, allowing companies to invest in growth, which can lead to higher stock prices. If the Fed hikes rates too much, it could cause a sharp downturn in the stock market. Investors, worried about the impact of higher borrowing costs, may sell off their stocks, leading to a significant drop in market value. This drop can trigger panic selling, causing the market to crash even further. 3. The risk of inverted yield curves. One of the most significant signals that the market is heading toward trouble is an inverted yield curve. Normally, long-term interest rates are higher than short-term rates because investors demand more return for lending money over a longer period. But when the Fed raises interest rates too aggressively, short-term rates can surpass long-term rates, creating an inverted yield curve. Historically, an inverted yield curve has been a reliable predictor of a recession. When investors see an inverted yield curve, they start to worry about the future of the economy. This often leads to a sell-off in the stock market as investors flee to safer assets. If the Fed's actions lead to an inverted yield curve, it could be a sign that a market crash is on the horizon. 2. A potential debt crisis. One of the reasons the market might crash due to the Fed's actions is the potential for a debt crisis. As the Fed raises interest rates, the cost of servicing debt increases for both individuals and companies. For businesses that have borrowed heavily, this could mean higher interest payments, which eat into profits. If businesses struggle to repay their debts, they might default, leading to further financial instability. In addition, if consumers are burdened by rising interest rates on things like credit cards and mortgages, they might start defaulting on their loans. A wave of defaults could ripple through the financial system, leading to a full-blown debt crisis and ultimately a market crash. 1. The psychological effect. Panic and fear. At the end of the day, the most powerful factor driving a market crash is psychology. If investors start to feel panicked or fearful about the economy, they may sell off their stocks in a hurry, causing the market to drop. This is often referred to as panic selling. If the Fed raises interest rates too aggressively, it could create a sense of panic among investors, especially if they feel that the economy is heading toward a recession. Fear can spread quickly, and once it does, it can lead to a mass sell-off. The faster people sell, the faster the market crashes. So now that we've broken down the possible ways the Federal Reserve's actions could crash the market, what should we do about it? The key takeaway is to stay informed and watch for signs of what the Fed might do next. If you're an investor, make sure your portfolio is diversified and always be prepared for the possibility of market volatility. As always, keep an eye on what's happening with interest rates and the broader economy. And remember, it's not just about the Fed's next move, but how the markets and consumers react. If you found this video helpful, make sure to hit that like button, share it with your friends, and subscribe to stay updated on all things related to the economy and investing. Thanks for watching, and we'll see you next time.